Usually when we look at a corporate earnings report, there is this expectation of precision.
Right.
It's kind of like looking at an X-ray of a broken arm. You see that jagged white line on the black background, and the doctor just points at it and says, there it is, that's the fracture.
Exactly. Yeah.
And when you look at a traditional balance sheet, for, say, a software company or a big retailer, you see the top line revenue, you look at the profit margins, and you think, okay, there it is. The business is fundamentally healthy, or, the business is fundamentally broken. I mean, it is supposed to be clean.
It is supposed to be clean. Yeah, because, human beings crave binary outcomes, right?
Yeah.
We want the numbers to act as this infallible diagnostic tool. Yeah. If the revenue line goes up and to the right, we just assume the underlying machinery of the corporation is, perfectly tuned.
Right. But then you step into the world of commercial biotechnology, and suddenly that financial X-ray machine is it's completely malfunctioning.
Oh, absolutely.
I mean, we are looking at an earnings landscape right now that is profoundly muddy. You have these GAAP accounting distortions, massive one-time legal settlements, pipeline acquisitions that frankly look like pure cash burn.
Yeah, cash incinerators, really?
Right, and looming patent cliffs that can make a genuinely thriving company look like it is just bleeding out on the operating table. Or, conversely, make a struggling company look like a rocket ship.
It is the absolute definition of diagnostic muddy waters. If you do not know how to read the underlying biological and regulatory mechanics of the business, you are going to misdiagnose the investment entirely. I mean, Wall Street analysts get this wrong constantly. Because they try to apply traditional discounted cash flow models to a business that is, at its core, inherently driven by binary scientific outcomes and just arcane accounting rules.
Which brings us to the stack of sources we are dissecting for our deep dive today. We're looking at Incyte Corporation.
Ticker symbol INCY.
Exactly. And their massive Q2 2026 earnings call. Because, if you just glanced at the headline numbers that hit the wires this morning, it looks like an absolute blowout.
It really does on the surface.
Right. Top line revenue for Q2 came in at $1.67 billion. That is up 38% year over year. Net product sales hit $1.49 billion, which is a 40% jump. If you're holding this stock, a 40% jump in product sales for a mature mid-cap biotech company triggers an immediate dopamine hit.
Oh, for sure.
You see that and you want to double your position immediately.
Yeah. But let's hold off on hitting the buy button just yet. Those headline numbers are a perfect example of how a balance sheet can just straight up lie to you if you don't read the footnotes.
Okay, lay it out.
Hiding inside that 40% growth is a massive accounting apparition. Management explicitly noted a $246 million one-time non-cash benefit.
Wow, $250 million.
Right, and this was entirely tied to a CMS, that's Centers for Medicare and Medicaid Services settlement regarding Medicaid rebate litigation for their dermatology drug, Opsalura.
Okay, I want to pause right here because this is where, retail investors can really get lost in the weeds. A $246 million non-cash benefit from a Medicaid settlement. Let's translate what that actually means mechanically.
Sure.
When Incyte sells a drug like Opsalura, they don't just pocket the list price, right? They have to offer massive rebates to government programs like Medicaid.
Exactly.
So they sell the drug today, but they know Medicaid is going to come knocking for their rebate check months or even years down the line. Am I framing that correctly?
That is the precise mechanism, yeah. Because pharmaceutical companies don't know exactly when or how much those rebate bills will be. Accounting rules literally require them to estimate the cost and hold that money in reserve.
Okay.
So they accrue these massive liabilities on their balance sheet over years. It is essentially a rainy day fund legally mandated by GAAP accounting to cover future government rebates.
Right. So they accrued this massive pile of cash, but then they ended up in a legal dispute over how much they actually owed Medicaid in the first place.
Yes, exactly. The litigation was essentially an argument over the formula used to calculate those rebates for Opsalura. Incyte argued, we owe less than the government initially claimed. And in Q2, that litigation was resolved in Incyte's favor.
Oh.
So suddenly they have this massive reserve fund sitting on the balance sheet that they no longer legally need to hold.
Man, it's like finding a $100 bill in your winter coat from last year and adding it to this week's paycheck.
That's a great way to look at it.
You didn't actually earn more money this week by working harder. You just realized the cash was yours all along.
Yeah.
So they take that $246 million reserve, they release it, and it flows straight into the Q2 revenue line, making it look like they sold, what, $250 million more in green than they actually did.
And that is exactly why we have to strip out the noise. If you model your future revenue projections on that 40% headline growth, your valuation of the company going into 2027 is going to be wildly inflated.
You'd be modeling a phantom sales trajectory.
Yes.
Okay, let's do the math then. If we back out that $246 million ghost number, where does the true operational core business actually stand?
So the core net sales, pulling out that settlement entirely, still increased by 17%.
Okay, honestly, a 17% true operational growth rate for a company generating over $1 billion a quarter is still incredibly healthy.
It really is.
It proves the broad-based demand across their portfolio is genuinely increasing. But it leads me to another anomaly in this report. Usually the first or second sentence out of a CFO's mouth on an earnings call is the EPS, right? The earnings per share.
The holy grail metric.
Right. It is the holy grail metric for traditional value investors. But they completely buried the EPS in this presentation. We got the revenue, we got the sales growth, but no screaming EPS number at the top of the deck. Why hide it?
Because the EPS looks absolutely terrifying on paper if you don't understand the comparative base.
How bad is it?
Well, Incyte reported GAAP expenses of $976 million for the quarter. That represents a 42% increase year over year. Right. To a layman, seeing operating expenses jump 42%, while true revenue only grew 17%, looks like a company that has completely lost control of its spending. It looks like they're just burning cash in the parking lot.
Yeah, I mean, when I see a 42% jump in OPEX, my immediate thought is that their labs are incredibly inefficient, or I don't know, they just went on a hiring spree they can't afford. But let me guess, this is another accounting distortion.
It is, it's basically an inversion of the distortion we just talked about.
Okay, explain that.
This massive 42% jump is highly distorted because the baseline they are comparing it to, Q2 of the previous year, 2025, was artificially low. In Q2 2025, Incyte received a $242 million settlement payment from Novartis related to a different intellectual property dispute.
Gotcha.
When a pharma company receives a massive one-time payment like that, GAAP accounting often applies it against their operating expenses, effectively subsidizing their R&D costs for that specific quarter on paper.
So last year's expenses looked artificially tiny because Novartis basically footed the bill for the quarter. And this year's expenses look huge by comparison, even though nothing fundamentally changed about how the company is actually operating.
You nailed it. When you strip out the massive one-time CMS benefit on the revenue side this year, and you strip out the massive one-time Novartis benefit on the expense side from last year, you get the true underlying pulse of the business.
And what's that pulse?
That pulse shows total operating expenses actually only grew by 5%.
Okay, wow. Expenses grew 5% and true net sales grew 17%.
Yeah.
I mean, that is a beautiful recipe for operating leverage. The core business is expanding much faster than the costs required to run it. But the archaic rules of GAAP accounting literally force them to report a massive 42% expense jump and a 40% revenue jump, completely obscuring the solid, stable 17% to 5% reality.
It's frustrating.
This is exactly why you cannot just run a stock screener for PE ratio in the biotech sector and expect to find the truth.
You have to read the transcripts and dissect the footnotes. But while we are looking at the health of the balance sheet, there are two fundamental numbers we need to establish before we even look at the drugs themselves.
Let's hear them.
First, cost of goods sold, or COGS, is sitting at a pristine 7% of net sales. Second, cash and marketable securities on hand sits at a war chest level of $4.5 billion.
I want to linger on that 7% COGS for a second because, I mean, if you are an investor used to looking at retail or manufacturing, that number doesn't even compute.
It sounds fake.
It really does. If you run a grocery store, your cost of goods sold might be 70% or 80%. You have to buy the physical apples to sell the apples. Even in high-end automotive manufacturing, COGS is massive because of the steel, the lithium, the labor. But here, it literally costs Incyte 7 cents to manufacture a physical product they sell for $1.
It is the defining financial characteristic of the biopharma industry. You are not paying for the chemical ingredients of the pill or the plastic of the tube. You are paying for the 10 years of scientific failures, the massive clinical trials, and all the regulatory infrastructure required to prove that the pill won't kill you. The 93% gross margin is what funds the massive R&D engine required to discover the next drug.
It is basically software margins applied to biology. So the balance sheet is a fortress. They are incredibly profitable on a gross margin basis, and they are sitting on $4.5 billion in cash.
Yep.
But to understand why they need that much cash, we have to look at the existential threat looming over the entire company. We need to talk about the LOE cliff.
The loss of exclusivity cliff.
Yeah.
It is the boogeyman that keeps every biotech CEO awake at night.
Truly.
When a company invents a novel drug, they are granted a patent, which gives them a monopoly to sell that drug for a set number of years. During that time, they can charge premium pricing to recoup their R&D costs. But the moment that patent expires, the LOE, the FDA, allows other manufacturers to produce generic versions of the exact same chemical compound.
And the generic manufacturers don't have to spend $1 billion on R&D? They just reverse engineer the chemistry, manufacture it for pennies, and flood the market.
The historical precedents are brutal. Look at what happened to Pfizer with Lipitor. Lipitor was the best-selling drug in the history of the world, generating over $13 billion a year in peak sales for lowering cholesterol.
Massive.
When it hit its LOE cliff in 2011, generic atorvastatin hit the market. Within 12 months, Lipitor's revenue didn't just dip, it collapsed by roughly 70%.
It just evaporated.
Completely evaporated. Companies can see their entire market capitalization wiped out if they haven't built a bridge of new drugs to replace the revenue of the expiring blockbuster.
And that brings us to Incyte's specific boogeyman. For a very long time, this company has been heavily reliant on a single cornerstone blockbuster drug called Jackify. And Jackify is scheduled to hit its massive LOE cliff in 2029.
The clock is ticking.
We're looking at a ticking clock. If Jackify's revenue craters in 2029, and they don't have new blockbusters ready to launch, the stock goes to zero. So the entire lens through which we have to view this Q2 earnings call is this. Is the $4.5 billion war chest being deployed successfully to build a bridge over the 2029 cliff?
Let's examine the foundational pillar of that bridge first, Jackify itself. Genetically known as ruxolitinib, Jackify generated $817 million in sales for the quarter, which is up 7% year over year.
Still growing.
Still growing. Prescription demand is actually up 9% across all its indications, primarily driven this quarter by a disease called polycythemia vera, or PV.
Let's break down the biology of what Jackify is actually doing. Polycythemia vera and myelofibrosis, these are blood cancers, but they aren't solid tumors like, say, a lump in your lung. They are diseases of the bone marrow.
Precisely. Your bone marrow is the factory that produces all your blood cells, red cells, white cells, platelets. In diseases like PV, there is a genetic mutation that basically jams the accelerator pedal in that factory down to the floor. So the bone marrow starts overproducing red blood cells. The blood becomes thick, almost like sludge. This leads to massive cardiovascular risks, strokes, and a terribly enlarged spleen because the spleen is desperately trying to filter out all this excess sludgy blood.
And Jackify targets the mechanism causing that overproduction. It's a JAK1 and JAK2 inhibitor.
Yes.
The JAK-STAT pathway in the body is basically the communication line that tells the bone marrow to produce cells. So Jackify comes in and cuts that communication line, slowing down the factory and thinning out the blood.
And it does it incredibly well, which is exactly why it generates over $3 billion a year. Now, seeing 7% growth for a drug this mature, this close to its LOE, is actually a testament to incredibly strong commercial execution by Incyte's sales team. The prescriber base is stable, and new patient starts are strong.
But if you are an investor, the most critical thing to watch with Jackify isn't that 7% growth, right? It is their defensive lifecycle management strategy. Specifically, their recent launch of Jackify XR, the extended release version.
Yes, the XR formulation.
Because I read the transcript on this, and honestly, the XR numbers look pathetic at first glance.
Yeah, they do.
The newly launched Jackify XR only generated $10 million in Q2, and management literally admitted it was mostly just initial inventory build at the specialty pharmacies. $10 million is a rounding error for a drug doing $817 million a quarter. Why are they dedicating so much time on the earnings call to a $10 million rounding error?
Because that $10 million is the first work in the defensive wall against the 2029 cliff. The strategy here is what management calls coverage versus adoption.
Coverage versus adoption, okay?
You have to understand how the U.S. healthcare system adopts new therapies. You cannot just launch a new, slightly more convenient version of a drug and expect oncologists to switch all their patients overnight. Before a doctor will even write a prescription, they need to know the patient's insurance will actually pay for it.
Right, if the insurance denies it, The patient is left with a massive bill, the doctor gets angry phone calls from the pharmacy, and the whole system just grinds to a halt. So step one isn't selling to doctors, it's selling to the insurance companies.
Exactly. Step one is coverage. Management noted they're on track to achieve 50% to 70% formulary coverage by year-end, citing major contract wins with the massive pharmacy benefit managers, the PBMs like CVS Caremark, Optum, and Express Scripts.
Got to secure the territory before you can move the troops.
That's it. Once they have 70% of the insurance market covering the drug, then they push the sales force to drive physician adoption. They expect that adoption to build gradually through 2026 and really accelerate in 2027.
But again, let me play the skeptic here. Why go through all this brutal negotiation with PBMs just to switch patients from one version of your own drug to another? I mean, standard Jackify is taken twice a day. Jackify XR is taken once a day. Is the convenience of taking one pill instead of two really worth millions of dollars in marketing and contracting?
Well, it is not about the convenience for the patient. It is about the stickiness of the revenue for the company. Defending this patient base is absolutely vital. If you can migrate a massive portion of your patients from the twice-daily original Jackify to the novel once-daily Jackify XR, you create a new patent moat.
Oh, I see.
When the generic manufacturers flood the market with cheap twice-daily ruxolitinib in 2029, a patient who is happily stabilized on the once-daily XR version is much less likely to be forced by their doctor to switch back to the older, more cumbersome dosing regimen. It is purely about preserving the franchise's revenue tail for as long as possible.
Because, as the CEO explicitly stated on the call, Jackify is the funding vehicle. It is the cash cow paying for the rest of the pipeline and the new product launches. If the funding vehicle stalls in 2029 before the new products reach escape velocity, the entire company hits a brick wall.
Which naturally pivots us to the drugs that are actually supposed to take the baton. If Jackify is the anchor, Opsalura is clearly the rising star. This is their topical dermatology cream. It generated $450 million in Q2.
Though let's remind everyone that $246 million of that $450 million was our CMS ghost number we talked about. The actual U.S. core sales, driven by real-world prescriptions, was $161 million, which is still up an impressive 22%.
And the underlying volume metric is really what you want to focus on here. Opsalura is capturing 46% of the branded topical NDRX that is new to brand prescriptions.
That's massive.
Nearly half of all new patients seeking a branded topical treatment for these specific skin conditions are being started on Opsalura.
Let's dive into the biology of what Opsalura is treating, primarily atopic dermatitis or severe eczema. Because this isn't just dry skin we're talking about.
Not at all. Atopic dermatitis is an incredibly debilitating chronic inflammatory disease. The patient's immune system is essentially hyperactive in the skin, causing severe inflammation, intense itching, and compromised skin barriers that lead to recurrent infections. Historically, dermatologists relied on topical steroids to treat this. But steroids are a blunt instrument. If you use them long-term, they literally thin the skin, cause severe localized side effects, and can even be absorbed systemically and suppress your body's overall adrenal function.
So the market was just desperate for something that wasn't a steroid. And Opsalura brings that same JK inhibitor technology we talked about with Jackify, the mechanism that cuts the communication line for inflammation, but it puts it into a cream.
Exactly.
So instead of taking a pill that shuts down immune pathways throughout your entire body, you just apply the cream to the inflamed skin and it calms the localized storm right at the source without the systemic toxicity.
It is a brilliant localized delivery of a powerful systemic mechanism. And capturing 46% of the new patient market share proves the dermatologists trust it. But the most critical detail from management on this call wasn't just the volume growth, it was the pricing power.
Oh, this is fascinating.
Yeah, they noted that their gross to net profile, the GTN, improved from the low 60s to the high 50s.
I love talking about gross to net because it exposes how opaque the pharmaceutical supply chain really is. Let's translate gross to net for the retail investor listening. When a pharma company like Incyte sets a list price for a tube of Opsalura, the gross price, they almost never collect that full amount.
Rarely ever.
To get the drug onto the insurance formulary so patients can actually afford it, Incyte has to offer massive rebates, discounts, and frankly, kickbacks to the pharmacy benefit managers. The net price is the actual cash Incyte gets to keep after all the middlemen take their cut.
Precisely. A gross to net in the low 60s means they were giving away roughly 60% of the drug's list price in discounts just to secure market access. Management made a strategic, deliberate decision during the initial launch phase to heavily discount the drug. They essentially bought market share.
Right.
They sacrificed early profitability to ensure the drug was covered by every major insurer, making it as frictionless as possible for dermatologists to prescribe it.
And now that they have the access and they command nearly half the market, they are tightening the screws. If the GTN goes from the 60s down to the 50s, that means they are keeping 10% more cash for every single tube of cream they sell.
Exactly.
It's like a major retailer quietly pulling back a 20% store-wide coupon after they've already addicted the neighborhood to their products. They keep the massive foot traffic, but suddenly their profit margins just explode.
It is a textbook commercial execution strategy. You take the margin hit early to build the habit, and then you flex your pricing power. The sheer volume of prescriptions is going to translate much more efficiently into actual top-line revenue growth going forward.
And we cannot ignore the international runway for this drug. Opsalura saw 34% growth internationally this quarter. And they are expecting European approval for moderate atopic dermatitis in the third quarter of this year. Management explicitly stated on the call that international expansion is a massive long-term growth driver that could double or triple their current international sales over time.
Double or triple international sales is serious long-term compounding. So if we look at the bridge over the 2029 cliff, Opsalura is clearly one of the main structural supports. But a company the size of Incyte cannot survive on dermatology alone. They need their hematology and oncology segment to perform.
And the hem-onc segment is definitely breaking out. Total segment revenue was up 69% to $222 million for the quarter. We saw solid numbers from Niktimvo at $60 million, up 67%, and Monjuvi at $54 million, up 72%, which was heavily driven by international uptake in follicular lymphoma and a strong launch in Japan. But the absolute showstopper in this portfolio was a drug called Zynyz.
Zynyz is a fascinating case study. It generated $50 million for the quarter. That is a staggering 400% increase year over year.
And it captured over 40% market share in first-line SCAC, which is Merkel cell carcinoma. Taking 40% of any market in just 12 months post-launch is practically unheard of in oncology.
It really is, but we need to contextualize this for you. Merkel cell carcinoma is an incredibly rare, highly aggressive neuroendocrine carcinoma of the skin. It is a niche indication. This isn't lung cancer or breast cancer affecting millions of people.
So why should an investor care? I mean, if Incyte makes $1.5 billion a quarter, why are we dedicating time to a niche skin cancer drug doing $50 million?
Because of what that $50 million represents internally. Rapid market capture and a niche indication is a massive, flashing, bullish signal for the company's commercial execution team.
Oh, okay.
Selling oncology drugs is incredibly difficult. It requires specialized sales forces who can talk peer-to-peer with leading oncologists, navigate complex diagnostic testing requirements, and manage severe adverse event protocols. Capturing 40% share in 12 months proves that Incyte's commercial infrastructure is elite. They know exactly how to identify a target prescriber base, educate them on a new standard of care, and convert their prescribing habits rapidly.
I see where you're going. It's not about the $50 million today. It's about the muscle memory. When Incyte eventually launches a multi-billion-dollar drug for a major indication, they aren't building a sales force from scratch.
Exactly.
They have a battle-tested commercial machine ready to deploy. It proves they aren't just a bunch of brilliant scientists in a lab. They are a highly effective, ruthless sales organization.
That's it. And that commercial infrastructure is the exact asset they're leveraging as we move into the pipeline pivots and acquisitions. We established they have $4.5 billion in cash and a sales team that can execute. The next logical question is, what are they buying to finish building the bridge over the 2029 LOE cliff?
Let's talk about the massive Vega Therapeutics buyout. Incyte acquired Vega specifically to get their hands on a single asset called latarcipart, internally known as 039. This is a phase 3 clinical drug for von Willebrand's disease. There must have been some time on this because the biological mechanism here is just fascinating. What exactly is von Willebrand's disease?
Von Willebrand's disease is the most common inherited bleeding disorder, affecting roughly 1% of the population, though we are primarily focused on the severe patients here. It is somewhat conceptually similar to hemophilia. In a healthy human, when you get a cut, your body triggers a complex clotting cascade.
Right.
A critical component of this cascade is von Willebrand factor. You can think of it as molecular Velcro. It circulates in your blood, and when a blood vessel is damaged, this Velcro sticks to the injury site and catches circulating platelets, clumping them together to form a plug and stop the bleeding.
But in patients with von Willebrand's disease, they either don't produce enough of this molecular Velcro, or the Velcro they do produce is defective. So their blood literally cannot clot properly. They suffer from severe spontaneous bleeding episodes into their joints, their gastrointestinal tract, and prolonged bleeding from minor injuries.
It is a devastating reduction in quality of life. And the data from latarcipart's multi-dose phase 2 VIT-3 study was presented at a major medical congress recently, and the efficacy was exceptional. The drug demonstrated an 81% median reduction in the annualized bleeding rate across patients with different disease subtypes.
An 81% reduction in bleeding is a life-altering efficacy number. You are essentially giving someone their life back. But what really stood out to me, looking at this from a patient burden perspective, is the delivery mechanism. Currently, patients with severe von Willebrand's disease have to undergo factor replacement therapy. This requires 2 to 3 intravenous infusions per week.
It's grueling.
You are literally tethered to an IV pole in a clinic for hours on end, multiple times a week, just to prevent spontaneous bleeding.
And latarcipart completely upends that paradigm. It is engineered as a once-monthly subcutaneous injection. You give yourself a small shot under the skin at home once a month versus sitting for an IV infusion 3 times a week. The reduction in patient burden is almost immeasurable.
It transitions the disease from a chronic hospital nightmare to a manageable home routine. And that incredible convenience, combined with the 81% reduction in bleeding, is exactly why you heard several analysts in the Q&A portion of the earnings call directly comparing latarcipart to a drug called Hemlibra.
That is the comparison that has Wall Street drooling right now. Hemlibra is a drug developed by Roche that completely revolutionized the hemophilia A market. It offered a highly effective subcutaneous option instead of constant IV infusions, and it rapidly became a multi-billion-dollar blockbuster, generating over $4 billion annually.
Wow. So if latarcipart is the Hemlibra for von Willebrand's disease, how big is the total addressable market?
Management noted that there is a hemophilia A-like population within the broader von Willebrand's disease spectrum, specifically the severe, frequent bleeders who require constant prophylaxis. That is a highly concentrated, easily identifiable pool of nearly 10,000 patients in the U.S. alone.
10,000 patients doesn't sound like a massive market compared to something like cholesterol or diabetes. But in the world of rare bleeding disorders, these biologics command ultra-premium pricing, often hundreds of thousands of dollars per patient per year.
Oh, absolutely.
If Incyte captures a significant portion of that 10,000 patient pool with a highly priced, life-changing once-a-month biologic, latarcipart doesn't just add to the balance sheet. It could literally become the new Jackify. It could replace the entire lost revenue stream in one fell swoop.
Assuming it successfully navigates the massive phase 3 trials and secures FDA approval. That is the inherent risk you take in biotech. Nothing is guaranteed until the FDA stamps it. But as the CEO noted on the call, latarcipart checked every single box for their business development strategy.
It really did.
It expands their established hematology franchise. It offers an incredibly attractive risk-reward profile based on the pristine phase 2 data, and it utilizes their massive cash balance to acquire late-stage de-risked assets. This is the textbook definition of how you aggressively buy your way out of a patent cliff.
But survival in biotech isn't just about what you have the capital to buy. It is equally about what you have the discipline to kill. And that brings us to the clinical graveyard. On this call, management officially announced they are killing your development of asset 058. This was their lead-targeted pipeline drug for a very specific mutation called JAK2V617F.
In the pharmaceutical industry, officially killing a lead asset is usually met with panic from retail investors. It means tens of millions of dollars and years of painstaking laboratory research literally just went down the drain. It is a total loss of capital. But if we analyze how and why Incyte killed 058, it is actually a profound reason to praise management's operational discipline.
Let's dig into the why, because during the analyst Q&A, someone asked if they killed it simply because of poor bioavailability. Bioavailability just means how much of the actual drug makes it into the patient's bloodstream when they swallow the pill. If a drug has terrible bioavailability, you have to pump the patient full of massive doses just to get a tiny bit to the tumor, which usually causes horrific toxicities in the gut or liver along the way.
Yeah.
So was 058 just a poorly absorbed pill?
Well, it was poorly absorbed, but management firmly pushed back on the idea that bioavailability was the only reason for termination. The chief medical officer stated they looked at the totality of the data. They looked at the pharmacokinetics, how the body absorbs, distributes, and metabolizes the chemical. They looked at the safety profile. They looked at the early efficacy signals.
Right.
And crucially, they evaluated all of that data against their next-generation backup assets currently sitting in preclinical development.
They ran the calculus and realized that even if they spent millions more trying to reformulate the pill to fix the bioavailability, 058 was never going to be a best-in-class, highly differentiated therapy. It was destined to be mediocre.
Exactly. In biotech, the worst thing a management team can do is fall in love with their own science. When you have a mediocre drug, the temptation is to force it through expensive phase 2 and phase 3 trials just to save face, hoping it squeaks by the FDA so you can at least try to recoup some costs. But Incyte refused to throw good money after bad. They looked at a flawed asset and ruthlessly cut it.
They killed their darling to protect the balance sheet.
They did, and they're immediately pivoting those financial resources and clinical trial slots to their next generation assets, targeting that exact same JAK2 mutation, which they believe have a much cleaner chemical structure and a clearer path to dominance. For a retail investor evaluating the long-term stewardship of their capital, this is exactly what you want to see. You want a management team that embraces the fail-fast mentality.
Okay, so they killed 058, which is great capital discipline. But they are fully leaning into another major hematology program that I find absolutely fascinating, the 9889 program. This drug targets a different mutation called mutant CALR, which is found in myeloproliferative neoplasms, or MPNs, the same family of bone marrow cancers that Jackify treats.
Right.
It is the first and only mutation-specific therapy to enter late-stage development for this specific target. But there is a massive regulatory fight brewing with the FDA over how they are running the trial, and I want to spend some time unpacking this because it feels like a defining moment for the company's scientific ambition.
It is a massive point of contention. To get a drug approved in this specific space, the FDA traditionally requires companies to use 2 standard clinical endpoints to prove the drug works.
Right.
The first is SVA35, which measures spleen volume reduction. The second is TSS50, which measures total symptom score improvement. Basically, does the drug shrink the massive, painful spleen, and does the patient feel better?
Those seem like perfectly reasonable endpoints. Jackify was approved based on those exact metrics. So why is Incyte aggressively pushing back against the FDA? Why not just use the standard playbook, hit the spleen and symptom endpoints, take the easy regulatory win, and get the drug to market?
Because taking the easy win fundamentally shortchanges the true revolutionary value of the 989 molecule. We need to go back to the mechanism of action. Traditional drugs in the space, including their own Jackify, are incredible at managing the disease. They shrink the spleen, they reduce the night sweats and the bone pain, but they're essentially symptom management. They do not eradicate the underlying cancer driving the bone marrow into overdrive.
It's like taking ibuprofen for a broken leg. It stops the pain, but the bone is still broken.
Exactly. But 989 is different. It doesn't just treat the symptoms. Management presented incredibly compelling data showing that 989 actually improves hemoglobin levels, meaning it reverses the severe anemia that typically plagues and eventually kills these patients.
Yeah.
And even more crucially, bone marrow biopsies showed that 989 actively reduces the malignant progenitors.
Let's translate that. Malignant progenitors are essentially the corrupt stem cells in the bone marrow that are constantly churning out the cancerous blood cells.
Yes. 989 is going into the bone marrow and actually killing the root cause of the cancer. It is demonstrating disease-modifying evidence. It is fundamentally altering the trajectory of the cancer, not just putting a Band-Aid on the symptoms.
So I see the strategy now. If Incyte just meekly agrees to the FDA's standard endpoints of spleen volume and symptom scores, 989 will hit the market looking like just another Me Too drug. It will look like a slight variation of Jackify. It might get approved, but it won't be able to command premium next-generation pricing, and it will struggle to completely displace the current standard of care.
Exactly. But by fighting the FDA, by insisting on including novel primary endpoints like hemoglobin improvement and active disease modification, Incyte is taking a massive regulatory gamble to officially prove that 989 is scientifically superior to everything else on the market. If they win this argument with the FDA, they don't just get a new drug approved, they establish a completely new dominant standard of care for mutant CALR patients.
It is a high-risk, incredibly high-reward strategy. And to make the commercial viability of 989 even stronger, They just announced a global collaboration with a company called Halozyme to create a better subcutaneous delivery system for it. They're already anticipating victory and optimizing the administration profile so it is easier for patients to inject at home. They are playing three-dimensional chess with the life cycle of this drug while the FDA is trying to make them play checkers.
And we see that exact same strategic depth and ambition in their solid tumor portfolio. Which brings us to the upcoming ESMO conference, the European Society for Medical Oncology. This is one of the most important scientific stages in the world, and management previewed two major data readouts we need to watch. The first is Asset 734, which is a KRAS G12D inhibitor being tested in pancreatic and colorectal cancer.
Let's talk about KRAS, because anyone who has followed biotech for the last decade knows that KRAS mutations were considered the undruggable holy grail of oncology. For years, scientists knew KRAS was driving some of the deadliest cancers, but the physical shape of the protein was so smooth that drugs literally couldn't find a pocket to bind to. It's like trying to climb a glass wall.
That is a perfect analogy. KRAS is basically an on switch inside a cell that tells the cell to divide and multiply. In a healthy cell, it flips on, the cell divides, and it flips off. But when the KRAS protein mutates, specifically this G12D mutation, the switch gets jammed in the on position. The cell constantly divides, forming an aggressive tumor. For decades, it was undruggable. But recent advances in computational chemistry have finally allowed companies to design molecules that can crack the glass wall and bind to the mutated protein, shutting the switch off.
And Incyte is advancing 734 in combination with standard chemotherapies in frontline pancreatic cancer. The CEO made a really interesting commercial point here. Pancreatic cancer is incredibly lethal and aggressive, and it is rarely a winner-take-all market for a single drug. Oncologists are terrified of depending on a single targeted therapy because the tumor will rapidly mutate around it and develop resistance.
Right. In pancreatic cancer, you have to hit the tumor with everything you have simultaneously. So even if Incyte isn't the absolute first company to market with a KRAS inhibitor, if 734 is highly selective, highly potent, and crucially has a clean enough safety profile that it can be safely combined with brutal standard chemotherapies, it can carve out a massive, highly profitable slice of the market.
It doesn't have to be the only drug. It just has to be the best combination partner. But as exciting as breaking the undruggable KRAS target is, the solid tumor asset that really caught my attention in this transcript is Asset 890. This is a bispecific antibody targeting both TGF-beta and PD-1, primarily being tested right now in colorectal cancer.
This is where understanding the deep clinical nuances of immunology translates directly to understanding future market share. Let's break down the current standard of care. For certain aggressive colorectal cancers, the foundational treatment involves a drug called bevacizumab, often referred to as Bev.
Bevacizumab is a VEGF inhibitor. It essentially starves the tumor. Tumors need a massive blood supply to grow, so they send out signals to the body to grow new blood vessels toward them. Bevacizumab blocks those signals, cutting off the blood supply and starving the cancer.
Exactly. It is highly effective and foundational to treatment. Now, over the last decade, the other massive revolution in cancer care has been PD-1 inhibitors like Keytruda. PD-1 inhibitors work by taking the brakes off the patient's own immune system. Tumors often wear a molecular disguise that tricks the body's T cells into thinking the tumor is a normal, healthy cell. PD-1 inhibitors rip off that disguise, allowing the T cells to recognize and slaughter the cancer.
So, naturally, if you are an oncologist, you think, great, I'll combine bevacizumab to starve the tumor of blood and a PD-1 inhibitor to unleash the immune system to attack it at the same time. The ultimate 1-2 punch.
But biology rarely cooperates with simple logic. When oncologists try to combine a traditional systemic PD-1 inhibitor with a traditional VEGF inhibitor like bevacizumab, the overlapping toxicities are often too severe for the patient to handle.
I see.
The immune system gets too hyperactive, the blood vessels get too compromised, and the side effects become lethal. To make the combination safe, you often have to dial back the dose of the bevacizumab.
And if you compromise the dose of your foundational drug, you compromise the efficacy of the entire treatment regimen. You are fighting the cancer with one hand tied behind your back just to keep the patient alive.
Precisely. And this is why Asset 890 is such a potential game changer. It is a dual mechanism bispecific antibody. It doesn't just blindly take the brakes off the immune system everywhere in the body. It targets PD-1, but it also targets TGF-beta, which is a specific immunosuppressive protein that the tumor secretes into its immediate microenvironment to protect itself.
It's like a highly targeted bouncer. Instead of just opening the doors to the club and letting a riot happen everywhere, 890 specifically neutralizes the bouncers the tumor hired to protect itself, allowing the immune system to attack exclusively at the site of the cancer.
And because the immune activation is so localized and targeted, early clinical data suggests that Asset 890 can be paired with a full, uncompromised dose of bevacizumab safely. The severe overlapping toxicities are mitigated by the dual mechanism design.
That is a massive structural differentiator. If you are a treating oncologist staring at a patient with metastatic colorectal cancer, and Incyte can offer you the devastating power of a PD-1 therapy without forcing you to dial back the foundational bevacizumab, you choose Asset 890 every single time. It completely rewrites the frontline calculus for the disease.
And management isn't being shy about their expectations. They stated on the call that they believe they have generated the best single-agent activity ever reported for a PD-1-based therapy in MSS colorectal cancer, specifically in patients with challenging liver metastasis. The full dataset they are presenting at the ESMO conference is going to be a major, highly scrutinized de-risking event. The data holds up to the hype they generated on this call. Asset 890 instantly transitions from a promising scientific experiment to a foundational, multi-billion-dollar pillar of their future valuation.
So if we take a step back and recap the R&D pipeline we just dissected, they bought a potential blockbuster in rare hematology with Vega and latarcipart. They ruthlessly killed failing programs like 058 to protect their cash flow. They are engaging in high-stakes regulatory warfare with the FDA to establish a new disease-modifying standard of care in bone marrow cancer with 989. And they have a highly differentiated bispecific solid tumor asset heading into a major data readout that could rewrite colorectal cancer treatment.
That is an incredibly busy, deeply aggressive, and scientifically ambitious R&D organization. They're firing on all cylinders to build that bridge to 2029.
But all of that aggressive development, all of those clinical trials and all of those acquisitions come with a massive, unavoidable price tag. Which leads us perfectly into the final analytical section of our deep dive today, management guidance and the future outlook. Because while the science is thrilling, the accounting reality of paying for it is brutal. Let's start with the top line, which was undeniably positive. Management raised the roof on their revenue expectations. They bumped full year 2026 total net sales guidance to a range between $5.13 billion and $5.26 billion.
And that upward revision is entirely supported by the operational strength we analyzed in the core business. They updated the Opsalura forecast to $1.05 billion to $1.1 billion for the year. That officially elevates Opsalura to blockbuster status, which is a massive psychological and financial milestone.
A huge deal for them.
Now, we do have to remember that this raised guidance bakes in the $300 to $310 million total CMS settlement impact we discussed earlier. But even backing out that ghost money, the underlying prescription growth trajectory is spectacular. They also raised the HemOnc forecast to $860 to $890 million, heavily influenced by the breakout commercial performance of Zynyz.
So the top line looks pristine. Revenues are climbing, the commercial teams are executing. But then, as an investor, you scroll down the press release, you move past the revenue, and you hit the operating expense guidance for the rest of the year. And your jaw completely drops. JAP R&D and SG&A guidance was raised significantly to nearly $5 billion for the year. Specifically, they are forecasting $4.915 billion to $4.995 billion in expenses.
It's a staggering number on paper.
Staggering doesn't even cover it. If I am a retail investor and I see a company generating roughly $5.2 billion in revenue, but they are projecting $5 billion in operating expenses, that leaves essentially zero room for GAAP profit. Operating expenses jump by $1.27 billion in a single projection. I look at that and my immediate hypothesis is panic. Are they just blindly throwing cash at every lab experiment because they are terrified of the 2029 Jackify cliff? Have they lost all financial discipline? It is a totally rational fear if you are just lancing at the top line numbers. But this goes back to our earlier discussion about the distortions of GAAP accounting in the biopharma sector. When a company makes a massive strategic acquisition like buying Vega Therapeutics to get latarcipart GAAP rules dictate how they have to account for the cost of the unapproved drug they just bought. That $1.27 billion jump in expenses is not organic bloat. It is almost entirely the one-time bill coming due for the Vega acquisition. Let's break that down mechanically. When they bought Vega, they didn't just buy a building. They bought the intellectual property for latarcipart.
Correct. And because latarcipart is still in phase 3 trials and doesn't yet have FDA approval to be sold commercially, JAP requires Incyte to record the massive upfront purchase price as acquired in-process research and development expense. They have to take the entire multi-hundred-million-dollar hit to the income statement immediately in the quarter the deal closes, rather than amortizing it over time like a traditional capital asset.
So that massive spike in R&D expense isn't because their internal scientists suddenly demanded $1 billion for new microscopes. It's essentially a massive one-time accounting entry reflecting the check they wrote to buy Vega, plus all the legal and transaction fees associated with closing the buyout.
Exactly. Management also noted they baked in about $50 million in ongoing operational costs to fund the massive phase 3 clinical trials for latarcipart through the remainder of the year. So when you contextualize it, this is not a sign of operational inefficiency or panic. This is a deliberate, massive, and highly strategic capital allocation. They are deploying their balance sheet to buy a de-risked phase 3 asset that has the potential to generate billions in revenue over the next decade.
Okay, so it is a one-time shock to the accounting system, but it undeniably compresses their profit margins severely in the short term. The EPS for this year is going to look abysmal compared to historical norms. And this brings me to my absolute favorite quote from the entire earnings call. It was delivered by the CEO during the Q&A session in response to an analyst grilling him about this exact margin compression. It feels like the definitive mission statement for the entire company's current posture. The CEO bluntly stated, 12 months of margin compression to set up 10 years of revenue and earnings growth is a smart calculation.
That quote is phenomenal because it is management speaking directly and somewhat defiantly to the Wall Street analysts who only care about next quarter's EPS, and frankly, to retail investors who might be getting skittish. It is an explicit instruction on how to interpret their current financial state. They are fully, unapologetically acknowledging that the GAAP earnings are going to look incredibly ugly for the next 12 months. The margins are going to be compressed by these massive R&D investments and upfront acquisition costs.
But they are demanding that you look at the why. They are asking investors to accept short-term optical pain on the income statement to ensure actual long-term survival of the corporation. Because the math is simple. If they don't spend this $1.27 billion right now to acquire Vega, if they don't heavily fund the aggressive phase 3 trials for the 989 program to fight the FDA, if they don't push the solid tumor assets at ESMO, they will hit that 2029 Jackify patent cliff at 100 miles an hour with absolutely no airbags.
Exactly. The 10-year setup is the structural steel of the bridge over the LOE cliff. And what is crucial for an investor to realize is that every single line item in their profit and loss statement right now is either absorbing, offsetting, or directly funding the specific growth strategy. The 93% gross margins on their mature commercial drugs like Jackify are generating a river of cash, and management is relentlessly, efficiently deploying that river of cash into the highest probability phase 3 assets they can find or build. They are explicitly telling the market, we are not optimizing for a fixed margin percentage today to make the stock screener look pretty. We are optimizing for a post-Jackify world tomorrow.
Which brings us to the final, actionable bottom line of our deep dive today. We have dragged you through a massive amount of clinical trial mechanics, accounting anomalies, biological pathways, and regulatory warfare. Let's synthesize all of it. If you are a retail investor looking at the totality of Incyte's Q2 performance, is the signal here fundamentally bullish or bearish?
Based strictly on the empirical data and the strategic execution outlined by management on this call, the signal is unequivocally bullish.
I agree entirely, but let's recap exactly why, point by point, so there is no ambiguity. First, the core commercial business, when you strip out the legacy Jackify revenue and you back out all the convoluted accounting benefits like the CMS settlement, is organically growing at an incredible 44%. Opsalura is not just capturing 46% of all new patient starts in dermatology. Its underlying pricing economics are vastly improving as they successfully dial back those early gross-to-net discounts. The commercial engine is humming.
Second, their capital discipline is practically pristine. They are demonstrating the willingness to ruthlessly kill failing trials like the 058 program to prevent long-term cash bleed. Simultaneously, they're aggressively deploying their massive $4.5 billion war chest to acquire highly transformative, de-risked phase 3 assets like Vega and latarcipart. They are buying future revenue while protecting current margins from bad science.
And third, their commercial execution in hyper-competitive niche markets is proven. Taking a 40% market share in first-line Merkel cell carcinoma with Xians in just 12 months definitively proves they have the elite sales infrastructure required to launch whatever complex oncology assets eventually emerge from their pipeline.
So the actionable takeaway for you as an investor is this. Do not be fooled by the GAAP accounting distortions that make the headline ETS look weak. The massive R&D spikes will make the earnings look optically ugly in the short term, but the underlying cash flow generation of the core drugs is immense, and the pipeline execution is highly focused. If you are currently holding this stock, management is actively successfully building the bridge over the 2029 Jackify loss of exclusivity cliff. You just have to have the stomach to walk across it with them over the next few years, ignoring the quarterly noise.
Okay. To wrap up our deep dive today, we always like to leave you with a final provocative thought, something that builds on the data we just exhaustively analyzed, but pushes the perspective one step further. We've spent this entire time talking about Incyte aggressively acquiring smaller companies like Vega to bolster their pipeline. They're sitting on $4.5 billion in cash, they have immense gross margins, and they clearly have the appetite for late-stage deals. So the obvious surface-level question is, who might Incyte buy next? But I want to flip that perspective entirely. Let's look at the broader ecosystem.
Let's consider the macro environment in biopharma right now.
Exactly. We know that big pharma, the massive $100 billion market cap titans like Pfizer, Merck, and Bristol Myers Squibb, are facing their own apocalyptic LOE cliffs in the early 2030s. Their mega blockbusters are expiring, and their internal pipelines are notoriously thin. They are absolutely desperate for de-risked late-stage oncology and immunology growth to replace that lost revenue. Now look back at Incyte. Their valuation might currently be artificially lagging because Wall Street algorithms are too focused on the short-term margin compression and the impending 2029 Jackify cliff.
But if a major pharma player with a massive balance sheet looks past those gap distortions, just like we did today, the calculus changes entirely.
What do they see? They see a mid-cap company that has already built a highly profitable 46% market share dermatology juggernaut in Opsalura. They see a phase 3 hematology asset in latarcipart that could genuinely be the next Hemlibra. They see a potential best-in-class, dual-mechanism solid tumor asset in asset 890 that could pair with full-dose bevacizumab without killing the patient. And they see a battle-tested commercial sales team that can execute flawlessly in niche markets.
It raises the ultimate question. With their market valuation potentially lagging the true long-term scientific worth of this incredibly mature and diversified pipeline, could Incyte themselves transition from being the aggressive predator in the M&A market to becoming the ultimate prey? Could they be the perfect turnkey acquisition target for a massive pharma titan looking to instantly buy a multi-billion-dollar oncology and dermatology franchise to solve their own patent cliff problems?
That is the thought we wanted to leave you to mull over today. When you look at the corporate X-ray of a biopharma company, sometimes the most valuable things aren't the bright white lines of current revenue. They are the subtle shadows of future potential that the rest of the market hasn't priced in yet. Keep analyzing the data, look past the ghost numbers, and always stay curious. Thank you for joining us on this deep dive.